Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Friday, September 23rd, 2022. And our top story today, Americans keep running up credit card debt as interest rates rise. Well, Ted, it's great to see you. Thanks so much for joining us on the program this morning.
My pleasure. Thanks for having me.
All right, Ted, bankrate.com, a great website, great group of professionals that look at interest rates, look at credit card rates, and a lot more. Americans, though, piling up more credit card debt, which is kind of a reversal, Ted, from what we saw during the pandemic when people actually paid down their debt. But I want to get your thoughts on this. How are Americans doing when it comes to their credit cards?
Yeah, you're right. There are some troubling trends here. There was a time back in Q1 of 2021 that credit card balances were down 17% from their peak, which was reached just prior to the pandemic in Q4 of 2019. However, since the first quarter of last year, we've seen credit card balances rise in 4 of the last 5 quarters. Now we're within 4 percentage points of an all-time high, according to the New York Fed. And we have several factors making this worse. It's not just higher balances, but it's high inflation, obviously. It's higher interest rates. The average credit card right now charges 18.16%, and that's actually the highest since 1995. So people are feeling it on all fronts, unfortunately.
Yeah, I mean, look, you go out and you try to buy food. It's, I think inflation is measured at 8.6% or somewhere thereabouts, obviously significantly higher. I think people really are just trying to figure out how to account for that. Now, let's talk a little bit about how interest rates, and a lot of us hear what the Fed is doing. Jay Powell makes some demonstrative statements, those are my words, not his, about interest rates, and the Fed has increased rates. How do those interest rate changes play into the credit cards that we all use every day?
Well, first of all, I don't think a lot of people realize this, but when the Fed moves, your credit card rate moves. Almost all credit cards have variable rates. They're tied in with the prime rate, which is usually 3 percentage points above what the Fed is doing with the federal funds rate. So in other words, the card company doesn't need to give you specific notice. It's already in your terms and conditions that if you have a variable rate, you're paying the prime rate plus whatever their margin is. It's often something like prime plus 12 or 13%. That's about average. So what the Fed has done has pushed your rate up. Later today, we're anticipating this 3/4 percentage point rise. So when and if that happens, that's going to be 3 full percentage points just since March. And every quarter point has a $100 difference over the life of those minimum payments. If you have the average credit card debt, which is a little over $5,000, according to TransUnion, and the average interest rate, which is a little over 18%, according to our bank rate data. So minimum payments are a bad idea. That's going to keep you in debt for a really long time, cost you a lot of money in interest. The total interest bill there would be about $6,600 and moving up from there. So my best advice is pay way more than the minimum, pay all of it if you can. Or if you have debt, no shame, a lot of people do, look into something like a 0% balance transfer card. That could provide you with up to 21 interest-free months.
Ted, thanks for that information. Let's talk a little bit about the credit score and how that kind of factors in here. So you mentioned interest rates are going up, or we mentioned collectively interest rates are going up. That necessitates credit card issuers raising their rates. But let's talk about what that debt means on the credit score that a lot of us see on TV. We get on our bank statements. We get a free credit report every year. How does that all kind of translate to our credit score?
The biggest factor in your credit score is your payment history. So we certainly want you to be paying on time every time. The second biggest factor, which makes up 30% of your FICO score, is how much you owe. And a big part of that is your so-called credit utilization ratio. This is mostly on credit cards and other revolving debts. It's how much credit you're using divided by how much is available to you. And another thing a lot of people don't realize is that it's usually reported on your statement date. So even if you pay in full to avoid interest, which is a great practice, even if you do that, you may still have a high utilization rate that's dragging down your score. Because if you use that card a lot, your statement may show a hefty balance relative to your credit limit. There's this rule of thumb that says you should keep this ratio below 30%. Many of the people with the best scores keep it below 10. Whatever it is now, you can benefit by bringing it down. So a good tip is to make an extra payment in the middle of the month. It knocks that statement balance down before it even comes out.
Yeah, really, really good advice. Ted, I need to hold you over because I need to take a commercial break. When we come back, we'll talk more about managing your credit card debt if you got it. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you over 50? Would you like to get up to 33% more income in retirement? Then call now for this free book, Annuity Do's and Don'ts for Baby Boomers. This free book reveals little-known secrets about annuity strategies that will help you make the right choices before buying an annuity. Call right now for your free book, and as a bonus, we'll also throw in a free annuity rate report, both absolutely free for calling Annuity General today.
Call 800-504-8194.
Well, Ted, thanks so much for staying with us this morning. I really appreciate you having you back here in segment 2.
Of course, thank you.
One of the things that I wanted to ask you about, Ted, is buy now, pay later, and or BNPL. I see it, I read it, I hear it every day. First, what exactly is buy now, pay later? I think it's pretty self-explanatory, but you're the expert.
We're talking about companies like Affirm, Afterpay, Klarna. PayPal has a version of this. Apple has a version of this called Apple Pay Later. The general framework is often 4 interest-free payments over 6 weeks. Sometimes the plans last longer with or without interest. A lot of people, especially young adults, are drawn to this. It's kind of historically been for young people without much money, without much credit. It gives you a little breathing room in the budget. Although we have seen people of all ages gravitating to this. It's become a $100 billion industry. It's really been growing rapidly. And you often see this at the point of sale, like you're checking out online and a retailer might say, hey, do you want to split this up with our partner? I think it could be a good deal, but I also think it can sometimes be a ticket to overspending and impulse buying. You need to be really mindful of the terms you're being offered and also what your budget is, because sometimes it's deceiving. Like, oh, that's not a $200 pair of shoes anymore. That's 4 $50 payments. And it doesn't sound like that much, but you have multiple plans running at the same time and it can really stack up.
Now, thanks for that, Ted. And so, I would imagine that this is a good option for priority items. Like if I'm a guitarist, I like playing guitars, I like guitars, but this is probably not something that if I don't have the dollars to pay today or even at the end of the credit card period, I probably don't want to buy that. So I probably want to use this option, I would think, for more important priority purchases.
I think there's a key point in there, which is that this is still debt. Whether we call it that or not, this is still a form of debt. It does concern me that this concept has been extended to things like gas, for instance. Klarna has a partnership that lets people stretch out their gas payments. I know gas is expensive, but I also feel like that's just kind of a slippery slope of kicking the can down the road. I like your guitar example because I think one of the best ways to use this is to isolate a specific purchase. And some people even call it reverse layaway. It's kind of a new twist on that old theme. You get the item now and you pay for it over time. I think it could work for an expensive purchase like a guitar, a piece of furniture, a TV. Maybe you want to isolate that from the rest of your finances. You don't want to tack it on to this open-ended credit card balance that's charging 18% and goes on forever and ever. I think it could be responsible. Affirm has a well-known partnership with Peloton that I think is a great example that maybe you pay $50 a month for that bike or treadmill and you stretch it out a few years. You still need to consider this impact on your budget. But I do think that these chunks can make a big purchase more affordable and give you a lower rate and give you some light at the end of the tunnel too. People like the predictability as opposed to the open-ended debt.
Yeah, I have to tell you, I grew up not liking carrying over credit card balances. And even in difficult financial times like we're all experiencing, I like to make sure that first things first, I pay off my debt so that in the event that I need money, I need to borrow, something like that has to happen, I'm able to do that. I guess my last question here, Ted, is we talk a lot in this country about financial literacy. Many states are now offering programs or at least graduation requirements. You and the folks at Bankrate have done a tremendous job in terms of education. But do we need to do more with the help of credit card companies, buy now, pay later companies, financial firms in general, and educating people about how to use these financial instruments? It's not enough just to offer them and to give people free will in terms of using that, but also educate them on how best to use these types of instruments.
It's so important. I totally agree. Most of us don't get enough financial education at school or at home. A lot of parents are uncomfortable talking about this. We've done research that people would rather talk about almost anything else. They'd rather talk about their weight, their health, their religion, their political views. They'd rather talk about almost everything else as opposed to something like credit card debt. But I think it's important to bring finance out of the shadows. Most people don't get formal education. So I think to the extent that we can have these conversations with our spouse, our parents, our kids, I think communication is really important here.
Yeah, and it doesn't have to, it's not that complicated. I think, the time value of money, putting money away over a period of time, well, that has a inverse relationship if you're borrowing money. I don't think these are difficult concepts, but I think they're concepts that, look, even I, as a mature adult now, I need a refresher from time to time because there are things that I forget about because I haven't dealt with those issues. Well, keep up the good work, Ted. Ted, thanks so much for joining us. We really appreciate having you on the program this morning.
I enjoyed it. Thank you.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, entertainment, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content, or visit our website, and of course, our streaming partners. We're back again tomorrow for another edition of BRN Weekly. We'll be taking a look back at some of our best segments for the week. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.